Ladies and gentlemen, good day and welcome to Q4 FY24 conference call of GMM Pfaudler Ltd. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need an assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Ms. Priyanka Daga from. Thank you, and over to you, ma'am.
Thank you, Manav. Good day, ladies and gentlemen. A very warm welcome to all of you into the Q4 FY24 earnings call of GMM Pfaudler Ltd. The earnings presentation was uploaded on the stock exchanges this evening and is also available on our website. Hope all of you had a chance to go through it. From the management, we have with us our Managing Director, Mr. Tarak Patel, our CEO of International Business, Mr. Thomas K., our CEO of India Business, Mr. Aseem Joshi, our CFO of International Business, Mr. Alexander Pompner, and CFO of India Business, Mr. Manish Poddar. We will give you a brief overview of the performance of the company, after which we will get into the Q&A. Before we begin with the overview, a brief disclaimer. The presentation that was uploaded on the stock exchanges as well as our website, including our call discussions that will happen now, contains or may have certain forward-looking statements regarding our business prospects and profitability, which are subject to several risks and uncertainties. The actual results could materially differ from those in such forward-looking statements. I will now hand over the call to Mr. Patel to provide an overview of the performance. Over to you, sir.
Thank you, Priyanka. Good evening, everybody. We are happy to report a strong finish to the financial year, where we were able to grow both revenue and profitability by 8% and 11% respectively. Despite challenging business environments driven by a weakness in the chemical sector, we seen sequential improvement again in Q4 order intake that grew by about 14% to about 861 crores, driven by the long data technologies and system platforms. This is partly a result of our business diversification strategy and has helped mitigate the slowdown in the chemical sector by allowing us to focus on non-traditional industry segments. Edlon, also one of the companies that is there within the group, has seen an improvement in terms of order intake and in terms of EBITDA. This is mainly coming from the semiconductor industry. So like I mentioned, a lot of the new industries that we have diversified into is giving and making up some of the shortfall that has come from the slowdown in some of the key industries that we cater to. Further, we are currently having a strong opportunity pipeline as well, and we believe that the order intake for Q1 will continue also in a similar trend. In terms of financial performance, our consolidated revenues for the year grew by 8% to 3,446 crores, while EBITDA increased by 11% to 477 crores, with an EBITDA margin of 13.8%. Q4 revenue was at 741 crores and EBITDA stood at 91 crores with margins at 12.3%. Profitability margins improved in the international business, while margins in India have been kind of stable for the last few quarters now. This is the result of the ongoing cost control measures and the focus on operational excellence. Our balance sheet metrics have also seen improvement, and CRISIL has upgraded our rating to positive. There was a strong focus on improving our working capital during the year. This has resulted in significant cash inflows in H2, leading to higher debt repayment and improved debt ratios. Manish will be talking about this in a minute. In terms of corporate updates, we have completed the consolidation of Mixpro in Q4, Canada. The results have been published, include Mixpro. I also welcome a new member to the GMM family, Ms. Shilpa Dimirula, who has been appointed as an independent director effective May 22, 2024. With appointment, 70% of the board now comprises of independent directors. I will now hand over the call to Manish, our CFO in the India business, and he will take you through the financial performance of the company. Thank you. Over to you, Manish.
Thank you, Tarak. Good evening, everybody. We'll refer to the slide deck uploaded with respect to Q4 FY24. Apart from the P&L, our focus has been to strengthen the balance sheet. You may recall earlier in the year we had communicated that we target to repay 140 crores of debt in financial year 24. Happy to report that we have repaid 145 crores of long-term debt in this year. We have prepaid and closed the entire debt of Hyderabad and Vatva acquisitions that we took in past 2 to 3 years. Overall, we have repaid 96 crores of long-term debt in India and 50 crores of long-term debt in the international business. This has helped us improve our financial governance. Our net debt to equity now is at 0.4 and net debt to EBITDA is at 0.8. In the upcoming years as well, we plan to continue the journey. We have marginally improved our working capital days for debtors and inventories in the FY24, as referred in slide 8. Moving to cash flow front. On the cash flow front, we have significantly improved our cash generation in H2, as demonstrated in cash flow slide 9 of the deck. This is primarily on account of inventory optimization and cash collection focus. While in H1, due to operational reasons, our working capital has expanded. We brought it back to decent levels in H2. Overall, through the year, we generated 253 crores of free cash flow, which is a decent over 50% of EBITDA of 477 crores that we did in this year. With that, over to you, Priyanka.
Thank you, Manish. Madam, you can open the line for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Anirudh Shetty from Solidarity Investments. Please go ahead.
Hi. Thank you for the opportunity. I have 2 questions. Sir, I just wanted your update on the competitive environment in the domestic GLE space. You did mention that demand is still weak, but how has the competition intensity evolved since we last spoke? Just wanted some views on that.
Yeah, sure. So this is Aseem. I'll address it. Demand, as you know, continues to be a little sluggish. We have to compete vigorously. Having said that, we've taken efforts to, make sure that we are competitive from a manufacturing efficiency standpoint, or also reaching out to a broader set of customers. So I think that is helping us in winning more orders and capturing shares in what is right now a slow market for us.
I think maybe just to add a couple of points, the last 2 quarters have seen significant improvement in Indian glass-lined order intake. So I think we were kind of in Q1, Q2 around the 70, 80, 90 crore mark, which has doubled or increased to about 150, 160 crores in that quarter. So I think the glass-lined business has seen some improvement. I think our market share probably has also increased, but as Aseem mentioned, the competitive intensity is still there. And hopefully once the market and the industry kind of turns, you will see some of the pricing pressure cooling off.
Okay, and so your second question on the international front, the revenue seems to have grown, but the order intake, is declining. So just wanted, your read of the situation there in terms of, your conversations with the customers there. Are they, pausing some of the projects that they intend to do? Is there any delays happening there? Like some color around that, the global environment would be helpful.
Sure. So I will hand over the call to our international CFO in a second, but CEO in a second. What I would like to just mention is that do keep in mind that the international business obviously has a large component which is services, and that keeps adding on as the year progresses. So these are short delivery items. We do obviously understand that the starting backlog is a bit lower than last year, and that's definitely something that we are trying to improve and increase the order intake. We had received a large order in Q4, a $12 million order from the US, and we have further also this quarter seen another large order coming in from the US market as well. So in terms of order intake, the operating pipeline still remains very strong. Decision making has been a bit slower than usual, but we are seeing now some positivity, at least in US and Europe, where we do see order intake also improving, and we are seeing something similar here in India. Thomas, you want to add something as well, please?
Well, thanks for the lead, and I think there's not much to add to that what you said. The order intake, as you rightly mentioning, is lower than the revenue last year. That is because the markets have slowed down somewhat, but we are seeing recovery signs and signals in Europe as well as in America. So the projects are out there. Decision-making processes are slightly improving in speed. That is good news. We have been gaining a couple of large projects, especially in the Americas and the systems business, that were due. So we are above the expectations in that quarter and that business. China is a different issue. China is still rather slow. The number of projects is not necessarily increasing, but we expect the China recovery also very, very soon.
Got it. Thanks for answering my questions. I'll join back in the queue.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. You may press star and 1 to ask questions. We have our next question from the line of Bhavik Shah from MK Ventures. Please go ahead.
Yeah, hello, sir. So my question is, in the presentation, we have shown the EBITDA for next year at 630 crores as against revenue of 3,700 crores, which gets us to the margin of, say, 17%. But when we see historically our last, say, 10 years, we have only hit the 17% mark once in FY20. So what makes us so confident that we will be achieving those margins again this year?
You're talking about the guidance, right? The guidance was made, obviously, it was 2 years ago now.
So, Bhavik, just to give you a background, we 2.5 or 3 years back, we had given a guidance for 3,700 crores of top line and 630 crores of EBITDA. This slide is basically just a reference to where we are versus what we had guided to.
Right. So it's clear that obviously since that time the industry has seen a kind of a down cycle, especially the agrochemical industry, which is obviously a big chunk of our glass line business, and some of that you obviously see in terms of order intake and the current margin scenario. The idea obviously now is to kind of use this time, this kind of a down cycle, to kind of improve on internal cost efficiency measures, which we are working on. And we believe, and we do see some signs of recovery, and hopefully as the market recovers, some of the benefits that we will be working on today will kind of translate into much better margins as well. Going back to your question on historical margins, yes, from an industrial perspective, capital goods company, 13.8% EBITDA margin for the year in the peak of a down cycle, I think is a pretty decent performance, and I think we've kind of held our ground quite well. Going forward, obviously, we want to improve on this number, and that's what the kind of idea is. It's been 3 years since we've acquired the Pfaudler business, since the acquisition has happened, 3.5, 4 years. We've seen significant change in size and scale. Even the margins internationally have improved significantly, nearly doubled. The Indian margins are now kind of stable. We have obviously clear strategies for our different product lines. We have higher growth product lines coming from newer acquisitions. We have a heavy engineering business in India, which is also doing exceedingly well. So yes, some of the kind of risk associated with the down cycle in chemical and pharma is being kind of compensated by the other product lines, right? So I think we today are in a position to kind of start looking at maybe a 3-year plan again, and hopefully in the next maybe few quarters we should be able to kind of come back to the market with some kind of recalibration in terms of where we are and where we want to go. And I think that's something that we've been working on internally, and I think very shortly we'll be able to share some kind of roadmap with you and the investor community.
Right, sir. So got it. So this number which is in the presentation is not the guidance for FY25, if I understand correctly. Like we'll
guidance or that was given, we are just giving you a comparative to say that yes, this is the guidance that we have put out and how we are tracking towards that guidance. This will show you that we are not changing the guidance midway, so that number is out there and we are showing you where we are. Obviously, that guidance will probably get recalibrated when our new guidance comes in the next few quarters.
Okay, sir, got it. And just from an opening commentary, you're receiving good demand from your semiconductor industry. So what exactly do we provide there, and what kind of demand are we seeing, and in which subsidiary?
So we have a company in the US. It was historically part of the Pfaudler Group, and we used to make PTFE lined vessels. So these are very kind of corrosion resistant vessels, equipment for very high purity applications. And there's a very specific kind of a low metal requirement for the semiconductor, zero metal. I think parts per trillion is like 0 point something. And Edlon has capabilities and experience and technology that goes into this. And that's driving some of this improvement in that business. Semiconductor also is an interesting area for us, because not only do we kind of cater to them through Edlon, but there are other product lines that could also go into some of these semiconductor downstream or upstream kind of chemical facilities, right? There are specific chemicals that go into. So one of the areas that we're trying to see if there are other areas of adjacency is in the semiconductor space, where we could look at cross-selling some of our other equipment.
Right. So what percentage of our order book will be coming from this?
I think the size of Edlon today is about $25 million, $30 million, which 2 years ago was about $10, $12 million. So it's been significant growth. Alex, Thomas, you want to jump in terms of?
Yeah, the number that we are mentioning is quite right. It's about $25 million business. We expect this business to grow significantly further due to the investments that are done in the semiconductor industry in the Americas, but also starting in Europe right now. We are well positioned. The quality and the purity of our PTFEs that we are lining the tanks with is outstanding, and we are number one in quality performance in that industry. We have been investing in a new site, setting it up as we speak, having the capability to also provide all sizes that are needed: tanks, larger tanks, smaller tanks, and mid-sized tanks to the industry. And this is how we actually support the goals that we foresee.
Sure. Thank you so much.
Well, thank you.
Thank you. We have our next question from the line of Pramod Dandi from Unifi Investment Management. Please go ahead.
Yeah, hi. Thanks. Tarak, just on the international market, while we're going through the presentation, we saw that there's a note saying that they stated for the final value for the Mixel acquisition. So is there any one-off in the profit after tax we reported for the international business over there of just 2 crore rupees?
So, on Mixel, this was acquired last financial year, and as per the PP allocation that has to be done, once the revaluation has to be done within 12 months. So then this quarter we did that revaluation, and accordingly there was a inventory. So there was a intangible created, and that intangible, as per the PP, has to be amortized in this quarter, and therefore you have the one-time impact for the Mixel related transaction.
So how much would that be? If you can quantify that.
Yeah, about $1 million, I think.
It's around 8.5 crore.
Mixel will come probably next year. Mixel was approximately $1 million.
But I think what you're asking, I think what Mr. Rangi is also asking, is that there was a one-time charge for acquisition expenses. There has been, I think, a $1 million charge for acquisition expenses in this quarter. It's because we were kind of working on a couple of targets, and we had spent some money. There is a $1 million charge in this P&L as a one-time charge.
That is also there additionally.
Okay. So if so what we are comparing is the PAT reported on the slide number 28. If I look at the like to like, excluding the one-time charge, it will be more than 10 crore, right?
Yeah.
It is not mentioned anywhere in the note.
You're talking about the distance from EBITDA to PAT in slide. That's what you're talking about in the international business, right?
Yes.
So one is the amortization of the Mixel, intangible. That is what has happened. And the second one is the additional deferred tax provision that we had created in this financial year. And maybe Alex, you would.
And both of these are non-cash.
Both of these are non-cash.
Okay. So if you can quantify Mixel amortization, you said $1 million. What will be the amount?
We have given that as a note separately in the disclosure. That is just filed for the financials. You have that number in that disclosure. And
okay, I will refer to that.
Effective tax rate for the for the India and international business collectively stands at 27%. These are one-time adjustments on account of new entity acquisition and related deferred tax creation.
Okay, perfect. And the second is, how the total overall environment is looking into the, the international market now. We were saying that there was some slowdown, and because the international market was doing very well till last quarter, year on year. This is a one quarter where we have seen the year-on-year degrowth, quarter-on-quarter degrowth in the international market. So from where it is coming, how we are seeing it?
And maybe give you a little bit of what we expect. I think international business will probably trade around the same kind of margin for the next financial year. We are quite confident of that. There are a couple of areas that we need to call out. China is definitely an area where order intake has been slow, and we probably will face some absorption issues in China, but we expect the China recovery to happen, and we are planning for that. We are also doing a couple of restructuring exercises in Europe, especially in our UK site, where we have restructured that site to become a reglassing facility. So we've kind of reduced our cost structure there. In the meantime, we have also kind of started our journey of a low-cost source in Eastern Europe. So that first few orders have been placed to a local supplier there to cut down our costs in Europe. So many of these strategies that we are building will hold and help us maintain margins, if not improve. India also, we are going to be working on a transformation project here. So that's something that we are quite hopeful to in terms of cost saving. But generally, in terms of environment, if you had to compare with 12 months ago, I would still say that we are probably looking at slightly a more positive outlook. However, are we out of the woods yet? I would say we still have maybe 6 or 9 months before we see a complete turnaround, right? But the signs are positive, and luckily for us, we've made up some of the shortfall. We've been through the most difficult period with a lot of help through other business lines, like our heavy engine business, where we have catered to, let's say, the Adani Group or the Reliance thing, which is completely different from our traditional market of chemical and pharma, right? So, and then obviously, the services and the systems business internationally has also kept us and kind of made up for some of the shortfall that has come because of the slowdown in the chemicals and the subsequent impact on the glass lining business, right? So all in all, I think we've kind of made it through the toughest part. I think now that we have focused on internal cost control, I think we are going to be in a strong position to kind of get some of the benefits as and when the market were to turn. And starting the year today, I think with the 1,700 crore backlog is not a bad number. Obviously, at the highest point in the last 2-3 years, if you check, it would have been around 2,200. So that was a bit abnormal. The market was on fire. Somewhere between, let's say, 1,800 to 2,000 would be a good number to start with, right? So the focus is definitely on internal cost efficiency. At the same time, we are being aggressive in the market. And I think if the market were to turn a little bit more positive, which we expect it will, I think there will be a nice uptick in the business.
Okay, great. And if, lastly, if I may ask, on that, we have given this guidance 2 years back. Obviously, today, the margins are lower, the revenue is, is in line, but the margins. So is there any color which you can throw on those guidance which we had given 2 years back in terms of the ROC, EBITDA, and the revenue? Revenue may, is not an issue, but especially on the EBITDA and the ROC.
Yeah, so of course, EBITDA 630 is a tough call at this stage for FY25 for sure. We've done 277. So I think past 2 years have been given on track. But then, of course, with regard to the new scenario in which we are operating now, that 630 seems a bit difficult. We have been, as Tarak mentioned, we have been focusing on cost optimization and getting after the tail, as he mentioned earlier in his enumeration. So, and of course, ROC is just an outcome of what you earn. So, it will tag along
with the EBITDA numbers. But I think we are quite confident of growing the EBITDA number for next financial year as well. I think we all are aligned that yes, obviously it's been a tough year, but we have internal measures, we've already taken action, and we believe that we are in a strong position to at least maintain or grow margins, right? So the idea is to definitely grow and be kind of, at least in terms of cutting down cost structures where we can, and then make the improvements in terms of operational efficiency. We will definitely work towards that.
Okay. Yeah. Thanks.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to answer questions from all the participants in the conference, please restrict your questions to strictly 2 questions per participant. Should you have a follow-up questions, we request you to rejoin the queue. The next question is from the line of Pradyum Chaudhary from JM Financial. Please go ahead.
Yeah, hi. Thank you for the opportunity. So now that we are seeing a growth in our order intake, can we expect, going forward, do we expect maybe another couple of quarters of YY degrowth, or do we expect that from here on at least there will be some recovery in terms of YY growth? That's the first one. And for FY25, I understand that you want to come back later with the guidance, but some initial idea on what can we expect in terms of revenue, and the hope would be more towards recovery in the second half of the year. Would that be the case?
Yeah, do keep in mind that there's a minimum lead time associated with executing orders, and the lead times are different for both India and the international business. So in India, at least, we can book orders till maybe November of this year that kind of get shipped out in this financial year. In the international business, I think it's a little bit shorter time frame. So August would be the latest that we need some of these orders to come in. Do keep in mind also the international business has 30% of services revenue coming in. These orders can come in as and when till pretty much the end of the year, right? So all in all, I think the international business is starting off with a pretty decent backlog. There are certainly areas where we have, I would say, maybe shorter lead times, and in these facilities we need to kind of be more aggressive and book those orders, and that's what we are working on. But generally, in terms of guidance, I think it's better that you wait for the investor day. The strategic plan of the company is being worked upon. We had a board meeting today also where we have discussed this, and we will be coming to the external community with a presentation and a deck and our thought over the next 3 years, and what we expect the company to be strategically 3 years down the line, right? So I think just give us a couple of months here, and we will come back to you. In the meantime, just in terms of general outlook, I think you can say that next year should see some amount of growth, both in terms of revenue and profitability. And obviously, that is a bit of a conservative estimate, and if things improve rather quickly, then we could definitely outperform that, right? So I think it's better to kind of be a little bit conservative at the same time, and if the market turns, we will definitely take advantage of that.
All right, just to follow up here. So you've mentioned the minimum lead time for India to be November and for international to be August. As in, this is for the new orders which are coming. You're saying that's when you start supplying these new orders. Is that the case?
What I'm saying is, if I book an order in November, I can still ship it out by March 31st in India. If I book an order by August 31st in international, I can ship it out by March 31st. That's what I'm saying.
All right, understood. Thank you.
Thank you. We have our next question from the line of Keshav Mundra from Guardian Capital. Please go ahead.
Keshav, we can't hear you. Can you unmute maybe, or?
Keshav, are you there? Keshav, are you there?
No, I think maybe he'll get back in with you. Maybe we can try the next one, please, Manav.
The next question is from the line of Rahul Agarwal from Himalaya Investment Advisors. Please go ahead.
Thanks for the opportunity, sir. My question is more on the end user industries that we serve. do you think that there is significant overcapacity that has built into the end user industries, which would imply that the order inflow slowdown that we have seen over the last 2 quarters is likely to be a prolonged one over the next 3-5 years as you look at it? Or what sort of a growth rate would you expect from our core end user industries over the next 3-5 years?
So, I can give you some kind of maybe, idea in terms of what we are seeing. Predicting how these industries will kind of react would be a little bit difficult, but generally, let's break it down first into pharma. So I think pharma, we are already seeing a nice recovery. I think pharma looks good for the future. And pharma has seen all the pricing pressure in the US kind of reduced, and I think people are investing now. We have good large investments coming in pharma. Some of our key customers have outlined projects and large projects. I think the contract manufacturing in pharma is also picking up. And some of the companies that we are talking to are saying that, hey, listen, we want to compete with China, and we want to put up these kind of facilities and take them head on, right? So pharma is not looking that bad. I think what has really hit us is chemical, and in chemicals, basically agrochemicals, which has seen a lot of oversupply. I would not say overcapacity, but I think there's been dumping, overstocking, which has caused some of these kind of slowdown. But things like this can change very quickly, right? So we are already hearing that now in the next couple of quarters, this overstocking problem is going to kind of reduce, and some amount of the business is going to come back. Do keep in mind there's always going to be competition from China, and there was a lot of pricing pressure from the Chinese competitors. That's something that I don't know how exactly to play out, but probably it's not something that is very sustainable. But all in all, I think if you ask me, I would say about 9 months before we really see a significant change. So I think the next couple of quarters look somewhat similar. You will see some improvements, but I don't think it will be significant. I think significant reinvestment will probably start maybe early next year.
Got it. So that's very helpful. And typically, what are the replacement cycles for existing capacity that your customers have? Like, do these equipment last 10 years, 20 years? How do you think of replacement cycles? And second, from a longer than 3-5 year perspective, if you are to say, take a guess on where some of the capex, where would the capex will probably end up? Would you say high single digits? Would you say double digits? Where would you put that?
So I think first thing I just want to add before we kind of get into the first question is that as a company, and we deliberately try to diversify and take the risk away from our glass-line business. Glass-line business was nearly accounting for 80-90% of our business not so long ago. Today it's down to 50%, right? And also, chemical and pharma were accounting for nearly 80-90% of our overall business. That's also down to maybe now 50%, right? So as a company and as management, we've been very clear from day one that we need to diversify both the product portfolio and the industries that we serve, because having all your eggs in one basket, catering to only one or two industries is going to be kind of detrimental and very risky if those markets were to slow down, right? So today, I think we've been able to mitigate some of this risk and maintain our margins at a decent level because we've had these other businesses that have performed well when our glass-line business has slowed down. So I think glass-line for us, really the way that you should think about it is it's a bread and butter business. We are market leaders, but that's not a high growth market for us. We're going to consolidate this position, try and improve margins and kind of sell technology and really build on what we already have. The growth and the margin improvement in the other platforms is going to be much more significant, much more faster. These are smaller kind of businesses with high growth potential, low market shares where we can grow market share. And many of these new products also cater to some of these new tech and new age industries, right? So things like we spoke about semiconductor or things like, let's say, mock meat. These are things that we've served now, but these could be very significant markets in the future, right? So as a company, obviously, chemical and pharma are our traditional industries. And over time, we hope that our kind of exposure to this would be reduced, and we have other industries that kind of make up some of the segments as well, right? Team, Thomas, do you want to add something to this?
I mean, to your specific question about replacements, it really truly does depend on, the kind of application, the customer's maintenance cycles, etc. But as a rule of thumb, in India, typically you would see, for our reactors, anywhere between 7, 8, 9 years. Some of the competition reactors, of course, need to be replaced much sooner. In Europe, they tend to, be used more carefully, more sparingly, maintained much better. So the lives there tend to be a lot longer. That's sort of how I would respond.
Just one more point here, Rahul, is also that you keep in mind that the Indian industry has seen significant growth, chemical industry has seen significant growth in the last maybe 10, 12 years. This is when we started kind of supplying these reactors to the SRF, CI sections of the world. So now we are reaching a point where these reactors are kind of aging to an age where they would either need replacement, reglassing, or spare parts, right? So we do expect that the installed base, which is now quite large and has been there for the last 10, 12 years, will start providing some kind of services or reglass revenue. We hope to do that. And we've been kind of being proactive and preempting some of this by setting up, let's say, service centers close to our customers, putting more of a kind of focus on reglassing, and hopefully, like in the international business, which is a much more mature market, they already see 30 to 40% of the revenues coming in from reglass and services, right? So India currently is less than 10%. So hopefully there'll be a nice service and reglass component that could also kind of bump up, and hopefully that kind of comes in, in the next maybe few years or even earlier than that.
Got it. No, thank you for the perspective. That's very, very helpful. And the last question, the GLE side, you said you have diversified away from pharma as well. What would be the, but I couldn't get the numbers. Can you repeat what would be the end user industry composition broadly between pharma, agrochem, and others on the GLE side and also on the non-GLE side?
Yeah, 60 is chemical and 40 is pharma generally, only on GLE. There's a little bit of dyes and stuff like that. And these are the two industry segments that we only serve. There's a little bit of paints and dyes, but it's not significant.
So yeah, just to be clear, the industry segment breakup that Tarak alluded to was for the company, not only for GLE. The glass-line equipment primarily goes into chemical and pharma, with very few other applications.
So just to finish up this point, 3-4 years ago, if we were like 500-600 crores of revenue, we were 80% glass line, and today we are now half and half, right? So we've diversified, and let's say out of 1,000 whatever odd crores that we are doing, 500 comes from glass line, 500 comes from non-glass line.
Got it. Thank you so much.
Yeah. Yes.
Thank you. We have our next question from the line of Rohit Ohri from Progressive Shares. Please go ahead.
Hi, team. Couple of questions. During the year, we saw Thomas was busy cutting ribbons and inaugurating quite a lot of service centers or maybe revitalizing some businesses in Europe and US. How many of such events are still pending, or do you think how many of these restructuring or revitalizing processes are there?
Are you following us around, Rohit? How do you know? I guess you must have seen it on LinkedIn, right? Yes, service is a big component, and we have kind of created a couple of service centers in our existing facilities. So we don't really take new facilities, like we built a new service center in Mawag in Switzerland where we had a facility, and we are just adding this additional kind of workspace, similarly in Brazil as well, and in the Americas. But I think there's one more ribbon that you are going to cut. Sorry, there's one more that we added also now in Italy. But Thomas, we are also having another unit that we acquired 51% shareholding in the US, in the south of the US, where we will be inaugurating that factory in July, I believe, Thomas.
There's another ribbon cutting in the middle of July in the south of USA, in Georgia, where we have entered in a joint venture. We have built up a new facility together with a partner there, and it's specialized in reglassing and service stations. So we will have another service station, and we serve the southern part of the US and maybe Mexico much better in the future than in the past, and this will help us increase further our service footprint.
Okay. For the brand Mixion, by when do you think that it will be probably 50% of the total revenue?
Of total consolidated revenue? Wow. Yeah, it's very hard to say now. I think the target is we are currently around $40-50 million of revenue in mixing. I think the 100 million target is what we would like to achieve in the next 3 years or so. That's the plan. I think how that kind of fits into the overall scheme of things will be kind of difficult to guess. But I think if you had to take a number, 100 million number, the right number to kind of make it a platform with enough scale and size to have a separate kind of focus for that platform, right?
Mm-hmm. Do you think that it makes sense merging all the businesses, maybe IMSD, Mixel as well as MixPro?
Launching or relaunching? Sorry, what was the question?
Do you think that it makes sense merging all the mixing businesses?
Yeah, so we have merged the business internally. We now have a head of mixing that we hired from one of our big, competitors, I can say that. But yeah, so we are giving it the focus that it deserves. We're bringing in the relevant capabilities and expertise. And mixing is definitely something that we are focused on. We are now consolidating the designs, the brands between all 3-4 of them, and then creating a new go-to-market strategy for the mixing business. That's underway as we speak. And I think mixing, if we all believe, both Thomas and the team, you can jump in here as well, is going to be a very important part of our growth story.
I mean, the mixing industry in total is a very large industry, market that is bigger than the glass line. This is why we are so interested in participating and becoming a bigger player. And the acquisitions of the 3 companies over the years is giving us the critical mass to play there. Technologies are in most cases adjacent, some are overlapping, so there's a little bit of consolidation needed there. However, our main focus is on growing the business, growing the market share as fast as possible, rather than consolidating.
Mm-hmm.
There were 2 patents filed this quarter as well. I didn't mention that earlier. In the mixing space. So we are also developing new technologies along with the companies that we've acquired to really be innovative in mixing and differentiate ourselves from our competitors as well. So everything is ongoing. It takes a bit of time, but mixing is definitely a business line that is complementary. It's driven by technology and differentiated, and you're actually solving a problem for the customer. Either you're bringing down his fast time, his cost, his quality of his product. So there's a lot of benefits, tangible benefits for the customer that we can touch. And mixing is something that has been a strong growth driver for us in India for the last few years and now internationally as well.
And just to clarify, these are 2 patents that have not been filed, but they've been issued. So they are now granted in the name of GMM Pfaudler. These were filed, actually quite a while back and worked its way through the system, and now they've been granted.
Last one from my side. If Tarak and team, if you can take us through Altium and Pfaudler joining forces to revolutionize the extractive industry and something related to acid recovery or something of that sort. If you can take us through that initiative.
Yeah, so that's basically, it's not, just I can, but it's basically working along with an engineering company to kind of prepare and kind of use our equipment and their kind of process technology to kind of go to the customer together and give them a combined offer, right? Because sometimes as equipment manufacturers, we don't have the technical and process know-how, and these guys have it, but they don't have all the glass line equipment and candle and stuff. So we put it all together as one single package, and we work towards in trying to this is one way of kind of extending our market outreach, right? So it's a good position and a good place to be, but obviously we need to work together with them to go out and meet the requirements of the customer.
Do you intend to buy it out?
Sorry to interrupt, sir. I would request you to please rejoin the queue as there are several participants waiting for their turn.
Yeah.
Thank you. We have our next question from the line of Jay Modi from EIML. Please go ahead.
Hello. Good evening, sir. I had a similar question on mixing technology. So, have you started approaching customers with the product, and how has been the underlying traction for?
Sorry, we could not. You were breaking up. Can you repeat, please, Jay?
Sure. Am I audible now?
Yes, better.
Yeah. So I had a similar question on mixing technology. So how has been the traction for us? Have you started approaching customers with the product? What is the kind of reception that we've received on ground?
Yeah, so we've been selling mixing in India certainly for a long time as Mixel and Mixpro in their market. After the acquisitions of Mixel and Mixpro, we've been able to take expertise, previous track records, and sort of customer credentials from there and use them to sell into each other's markets. So there are, flue gas desulfurization, compressed biogas. Just two examples where we've been able to leverage our broader network and previous work done overseas and take them to customers here. And that's just an example. There's several other areas.
Yeah, so areas where we as mixing were mainly focused again on our traditional markets of chemical and pharma. With the acquisition of Mixel and Mixpro, we have had obviously significant opportunity in order intake in new industries. For example, metal and minerals is an area where we didn't have a lot of kind of business, and now we do work with the precious metals, Vedanta, and companies like that. At the same time, we were not there in wastewater, but now with Mixel, we've done wastewater kind of projects here in India. We're building Shapoorji Pallonji for certain kind of infrastructure projects as well. And on the other way, so stuff that has gone out from India as well. So India has been kind of a curve ahead in terms of fermentation, right? So we've done a lot of work here on fermentation with companies like Aurobindo and Wilco Group. In turn, now the same technology is now being kind of given outside. If people need fermentation technology within the group, that's something that, so it goes both ways. But having PCR and having experience, and the way that when we look at acquisition, we try and buy companies or look at acquisition targets which has the relevant experience which we don't currently have within the group, right? So that's a little bit of kind of area that we want to enter new markets, and by some of the experiences and PTRs that these companies have, we get automatic entry through these acquisitions.
Got it. So the incremental growth that you mentioned, reaching around $100 million of top line for mixing, is largely through international business, or will be driven from domestic revenues as well?
Both. It's a global number. It will come on board. The manufacturing obviously can be, pushed out to low-cost manufacturing. We don't need to have high-cost manufacturing. But yes, it's a global requirement. The market size that Thomas spoke about was a global market size, and mixing goes into everything, right? So you'll be supplying mixing to Saudi Arabia for their Aramco plants, right? You're going to be supplying mixing to cement factories in Southeast Asia, right? You're going to be selling wastewater to Vietnam and Australia. So it's really a global play. You could sell food and beverage things to Nestle in Europe or in Netherlands. So it's really a global play. Everybody needs mixing. And with the relationship and the network we have, we can definitely leverage the global network to sell some of these products and technologies. That's the idea. And it's all over the world. The growth will really come all over the world.
Got it. And sir, in standalone business, what is the kind of capacity utilization for this year or for the quarter?
Sure. So, we are in our glass line business, right now we're at about 65-ish, thereabouts. In some of the others, it's a little higher, 70, 75, thereabouts.
Okay, and glass line, sorry.
Go ahead.
And glass line can technically reach what kind of utilization? 80, 90%?
Yeah, so there's a lot of things. Certainly we can operate at 90% also. Obviously, the lead times become longer. However, there are a lot of times we can do to improve the throughput of our line, which is what we're currently doing. So once the market comes back, we feel confident that we can certainly drive a lot more output from the existing assets that we have in Karamsad and in Hyderabad.
Got it. And this quarter,
Sorry to interrupt, Jay sir. May I request you to please rejoin the queue? Thank you. The next question is from the line of Sarang Sanil from RW Investment Advisors. Please go ahead.
Hi, good evening, sir. Thank you for the opportunity. Firstly, what was the reason for this gross margin expansion? Was higher services revenue contribution the sole reason, or has the segment mix contributed to this?
You're talking about the material consumption reduction, is it?
Right. Yes, gross margin.
Yes. So the top line has grown quarter on quarter, so which is primarily on the product side, and the services are more stable. So as a natural outcome, so material cost consumption is better as a percentage, and therefore you see the improvement in that.
So we could expect it to revert back to the normal gross margins once things start picking up, correct?
Sorry, I didn't get that. Yeah, this is an exceptionally better raw material consumption. Once the mix is back, we should be back to the numbers.
Got it, sir. My second question was, what all went wrong in this quarter? Was our expectation? Because we were way off from the 2,000 crore order book, and India business was not better than Q3 either, as we had expected. Was there any large project that got postponed?
No, I think from a year perspective, I think we are on target. So Q4 has seasonality. I think we talked about this obviously in our last few conference calls. There is, obviously cycles that we face. There's a kind of increment cycle that happens in the international business in Q4. And also, I guess there were a few one-time costs this quarter. So generally, I think we are pretty much in line with what we had planned. I don't think there's any significant sign of surprise here. I think obviously, the year has been a kind of a flat year, and obviously starting next year at a better way would obviously be a nicer thing. So, I mean, there was no real need to kind of have an exceptional quarter this year, and I think with the order intake being much lower, even our execution has slowed down a little bit because we don't need to kind of eat into the backlog, right? So, I think starting for next year, again, with the backlog that we currently have, order intake obviously is a bit low. We would have liked to have definitely more. But again, like I mentioned, in a peak of a down cycle in our main traditional industries of chemicals, I think we've done pretty well. I think the market will return, then definitely I think that order intake will be a definitely uptick. But generally the outlook also remains kind of positive, saying that yes, we do expect to improve both revenue and margins for next year. Obviously, it's not going to be exponentially better. I mean, the market still needs some time to correct and improve, and we have to keep our head down and just make sure that we kind of, keep the faith and keep working on the internal cost, improvements that we've planned. We are being aggressive in the market. Some of these orders are now, large orders have come in as well, which puts us in a stronger position. There are a few kind of areas which are going to be still tough for the long term, like China, which we called out. But generally, I think it's okay. I think we are in a strong position today, and I think if the market will return, we will see some of those benefits flow through.
Sure. So just to cross-check one figure, so you said mixing revenue contributed to, $40 to $50 million for the year, is it?
Mixing today, the sum of the three entities or three brands is about 45 million currently.
Okay, so 13%, nearly 13% of the revenue. Okay, got it, sir. Thank you so much, and all the very best for the year.
Thank you. We have our next question from the line of Monisha Wadhwani from Share Capital. Please go ahead.
I think we lost Manav. So maybe we can now close the call, I guess. If you, Priyanka, you want to?
Yeah. As there are no further questions, I would now like to hand the conference over to the management of GMM Pfaudler for closing comments. Over to you.
Thank you, Manav. Thank you, everybody. Thank you, everyone, for joining us today. It was a pleasure interacting with you, and we look forward to many such interactions during the course of the quarter. Take care and see you soon.
Thank you. On behalf of GMM Pfaudler Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect.